6 years ago, one of the biggest names in precious metals quietly walked away from the gold and silver business. Most people believed that chapter had ended forever, but today, something has changed. That same major bank has suddenly stepped back into the market. And this time, the timing may be more important than the decision itself. Because banks don't return to industries they once abandoned unless they believe something far bigger is about to happen. Is this simply another corporate strategy? Or is it an early warning that the world's biggest financial institutions are positioning themselves before the next major shift in gold and silver? Stay with us, because by the end of this video, you'll understand why this comeback could reveal far more about the future of the global economy than most headlines ever will. Welcome to Next Alert, where we break down the biggest developments shaping the world of money, markets, and global economics in a clear and practical way. If you're joining us for the first time, and especially if you've been following the markets for years, we'd be honored to have you as part of our community. Please take a moment to subscribe, because every video is created to help you stay one step ahead of the headlines. And before we begin, let us know in the comments, which country are you watching from today? For years, the precious metals market appeared to be settling into a familiar pattern. Gold continued attracting investors during periods of uncertainty. Silver remained caught between its role as an industrial metal and a monetary asset. And the world's largest financial institutions focused their attention on technology, artificial intelligence, and equity markets. Few analysts expected one of the industry's most recognizable banking names to revisit a business it had deliberately abandoned. Then came the announcement. A major international bank had officially re-entered the silver and gold trading business after years away from the market. At first glance, the news seemed like another corporate restructuring, important to industry insiders, but largely irrelevant to ordinary investors. However, experienced market participants viewed the decision very differently. Banks rarely reverse billion-dollar strategic decisions. When a global financial institution exits a specialized business, the process is usually the result of years of internal reviews, regulatory assessments, capital allocation studies, and long-term forecasting. Returning to that same business requires another equally rigorous evaluation. Such decisions are not based on short-term optimism or temporary price movements. They are made only when executives believe the future has changed enough to justify the risks. That raises an important question. What has changed inside the global economy that convinced this bank the precious metals market is once again worth pursuing? The answer extends far beyond higher gold prices. Behind every major banking decision lies a network of economic signals. Commodity demand, central bank policy, inflation expectations, government debt, geopolitical tensions, and institutional investment flows all influence where financial institutions choose to deploy their capital. When those signals begin pointing in the same direction, banks take notice long before the broader public does. This is why the bank's return deserves careful attention. Most investors focus on headlines announcing record gold prices or sharp movements in silver. Professional institutions, however, spend more time studying the forces creating those price movements. They ask different questions. Where is global liquidity moving? Which industries are attracting long-term institutional capital? What risks are becoming more significant over the next decade rather than the next quarter? Those questions often reveal opportunities long before they become obvious. Historically, large bullion banks have played a central role in the precious metals ecosystem. Their activities extend well beyond buying and selling gold or silver. They provide liquidity to global markets, finance mining operations, assist corporate clients with price hedging, facilitate institutional trading, and connect producers with large-scale investors. Their presence helps shape the structure of the entire market. Walking away from such a business is significant. Returning to it may be even more significant. What makes this development especially noteworthy is the timing. The global financial landscape today looks remarkably different from the one that existed only a few years ago. Inflation remains a persistent concern in many economies. Governments continue managing historically high debt levels. Central banks have accelerated their purchases of gold, while geopolitical uncertainty has increased across several regions of the world. These are not isolated events. Together, they form a broader picture of a financial system undergoing meaningful change. Perhaps this bank is not attempting to recreate the past. Perhaps it is positioning itself for the future. If that is true, then this announcement is not simply about one institution returning to an old business. It may represent an early indication that some of the world's largest financial players believe a new era for precious metals is beginning. To understand whether that conclusion is justified, it is necessary to examine the forces driving this remarkable return, and why they may matter to investors far beyond the gold and silver markets. One of the biggest misconceptions in financial markets is that major banks react to rising prices. They don't. By the time gold appears on the front page of financial news or silver becomes a trending topic among retail investors, the world's largest institutions have usually completed months, sometimes years, of research. Their decisions are not driven by excitement. They are driven by probability, That is precisely why this bank's return deserves far more attention than the average investor realizes. For a global financial institution, reopening a precious metals trading operation is not as simple as hiring a few traders and executing new transactions. It requires regulatory approval, compliance infrastructure, capital commitments, technology upgrades, risk management systems, and relationships with mining companies, refiners, institutional investors, and international exchanges. Every one of those investments costs millions before the first ounce of gold or silver is even traded. No board of directors authorizes that level of spending because they believe next month's prices might be higher. They authorize it because they believe the next decade may look fundamentally different from the last. That distinction changes everything. Large banks constantly search for structural trends rather than temporary opportunities. They ask where global wealth is moving, which industries are becoming strategically important, and where institutional demand is likely to expand over many years rather than a few quarters. Today, many of those answers are beginning to point toward precious metals. Around the world, governments are carrying record levels of debt while central banks continue searching for ways to protect national reserves against growing geopolitical uncertainty. Inflation has eased in some economies, but confidence in long-term purchasing power remains fragile. At the same time, global demand for strategic commodities continues to rise as countries compete for resources essential to manufacturing, energy, and technological development. Gold and silver now sit at the intersection of many of these forces. Gold remains one of the few financial assets that carries no counterparty risk. Silver has become increasingly important not only as a monetary metal, but also as a critical industrial resource used in solar technology, electronics, and advanced manufacturing. For institutions managing billions of dollars, these are not isolated investment themes. They represent interconnected shifts that could reshape global capital flows for years to come. Viewed through that lens, this bank's return begins to look less like a corporate decision and more like a strategic repositioning. The real question is no longer why one bank came back. The real question is how many others may quietly be preparing to follow. Financial markets rarely announce the beginning of a new era. They whisper it. Long before television anchors start talking about a trend, before retail investors rush into the market, and before social media declares the next big opportunity, subtle changes begin taking place behind the scenes. Liquidity starts moving differently. Institutional capital quietly changes direction. Banks adjust their balance sheets. Commodity desks expand. Risk models are rewritten. To the average observer, none of these developments seem connected. To professional investors, they often signal that something much larger is unfolding. That is why the return of another major bank to precious metals deserves closer examination. On the surface, it appears to be one institution reopening a business line. But beneath that announcement lies a far more important question. What are the world's largest financial players preparing for? History shows that banks rarely compete for shrinking opportunities. They compete where they expect future demand to grow. Every additional institutional participant changes the structure of the market. More liquidity enters the system. More capital becomes available for mining companies. Trading volumes expand. Hedging becomes more efficient. Price discovery improves as more sophisticated participants engage with the market. But increased institutional participation also introduces new challenges. Greater competition can enhance market efficiency. Yet history reminds us that concentration of financial power has sometimes created concerns about transparency, regulatory oversight, and price manipulation. Those lessons have not been forgotten. This is why experienced investors focus less on today's headline and more on the long-term implications. The return of one major bank may not transform the market overnight, but if it becomes the first move in a broader institutional migration back toward gold and silver, the effects could extend far beyond the bullion market itself. And that possibility leads to an even more important question, one that could shape the future of global finance for years to come. When historians look back at major financial turning points, they often discover that the warning signs were visible long before the crisis or the opportunity became obvious. The same pattern has repeated itself for decades. Before the collapse of the Bretton Woods monetary system, governments quietly adjusted their reserves. Before the global financial crisis of 2008, credit markets began behaving differently months before headlines caught up. Even during previous commodity supercycles, institutional capital moved long before retail investors recognized what was happening. The lesson is remarkably consistent. Large financial institutions rarely predict the future with certainty, but they constantly reposition themselves for the future they believe is becoming more likely. That is why this bank's return to precious metals deserves attention beyond the announcement itself. Perhaps the most important question is no longer whether gold and silver remain attractive investments. The more significant question is whether global finance is entering a period where strategic assets regain the importance they once held. Around the world, governments continue carrying unprecedented debt burdens. Central banks are diversifying portions of their reserves. International trade relationships are gradually evolving, while discussions surrounding alternative payment systems and reserve assets continue to expand. At the same time, geopolitical competition has increased the importance of securing critical resources and reducing financial vulnerabilities. Viewed individually, these developments appear unrelated. Viewed together, they suggest that the global economic landscape is becoming more fragmented, more competitive, and increasingly focused on long-term resilience rather than short-term efficiency. In that environment, precious metals naturally become more relevant, not because they generate cash flow, not because they promise extraordinary returns, but because they have historically served as strategic stores of value during periods when confidence in traditional financial systems becomes less certain. This helps explain why institutional interest appears to be strengthening once again. If one major bank has concluded that maintaining a meaningful presence in precious metals is strategically important, competitors will almost certainly be evaluating the same question. No global institution wants to discover years later that it underestimated a structural shift while others positioned themselves ahead of it. Whether additional banks follow remains uncertain. Markets are influenced by countless variables, including monetary policy, regulation, economic growth, technological innovation, and geopolitical events. No single announcement guarantees the beginning of a new cycle. However, experienced market observers understand that major changes rarely begin with dramatic headlines. They begin with decisions like this: a quiet expansion. A new trading desk, a strategic hire, a business that unexpectedly returns after years of absence. Individually, these actions may seem insignificant. Collectively, they can reveal the direction in which the world's largest institutions believe the global economy is moving. And perhaps that is the biggest lesson from this story. The return of one major bank is not necessarily the headline investors should remember. The headline they should remember is that the financial system itself may be quietly repositioning around assets that many believed belonged to another era. Whether this becomes the beginning of a broader institutional trend or simply an isolated strategic decision will only become clear with time. But history has repeatedly shown that those who pay attention to the early signals often understand tomorrow's markets long before they become today's headlines. Thank you for watching Next Alert. If you found this analysis valuable, consider subscribing and becoming part of a community that looks beyond daily headlines to understand the deeper forces shaping the global economy. And now we'd like to hear from you. Do you believe more major banks will return to gold and silver trading over the next few years, or is this an isolated case? Share your perspective in the comments below.